Scale is the blockchain that's truly built different. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Hey everyone, before we get into the show, just some quick housekeeping notes here. We're conducting an audience survey of the Forward Guidance audience, and we're just trying to gather feedback on what are some of your favorite parts of the show, what could you see improved, and what's your general vibe of things so that we can try and improve it. So the link to the survey is in the show notes. So if you could fill it out, that would really help us with improving the show for you as we move forward into the year. Thanks, everybody, and back to the show. All right, welcome back to another roundup edition of Forward Guidance. We are once again missing our dad in chief, Tyler. Couldn't make it again this week. He's got some changes going on, so he's been busy with that. But that's okay. We will hold up the mantle for him. But we do have a special guest today. Quentin, why don't you introduce Andrew there?
Yeah, for sure, man. Andrew Stein's joining us, who's just joined Lecker, is a partner of mine and head of research, covering all things single asset and sector specific. So we thought we have a couple of theses cooking up and wanted to share one of them with Forward Guidance in these little quant corners we like to do. So that would be fun to bring Andrew on, give the pitch on Lyft. Everybody in the market's kind of pretty excited about the Uber story, and we think there's a deeper value here with a good pitch, and so we can get into that.
Sweet. Yeah, Andrew, great to have you. I can share my screen and follow along the charts and just let me know where you want to go. And for the listeners, I think this will be fun because often we're so deep on the macro world, so it'd be fun to look at the single name stuff, which is definitely not the world that I live in that much. So it'll be a fun little change up here.
Yeah, perfect. And thanks, guys. It's great to be joining the pod today. So we could flip to the first slide on the valuation multiples. Perfect. Yeah. So wanted to go through our thesis on Lyft today, which we took a position in recently. And at a high level, we think the stock has a great setup with a discounted valuation and then multiple catalysts for a positive change in perception on the fundamental side. So to start with this valuation chart, this shows the relative ratio of Lyft's consensus 2025 operating price to earnings multiple, which is 13.6. And that's relative to Uber's PE multiple of 23x. And that's the pink line in the chart up there. And so this ratio is currently at around 60% relative to Uber. And then when we compare the same ratio to other publicly traded duopolies on the chart there, including Pepsi versus Coke, Visa versus MasterCard, Lowe's versus Home Depot, and then FedEx versus UPS, it shows a steep discount versus the peer group average, which is around 80%. So that's one way we chose to look at it. And then this discount compares similarly on enterprise value to free cash flow and other valuation methodologies. You can flip to the next slide. And so one reason we identified for the discount and why we think this is like currently how Lyft's valued compared to Uber is due to a significant amount of selling pressure from investors in Lyft's private rounds. So Lyft reported a really strong third quarter earnings on November 6th, and the stock traded up over 30% after the earnings print, which you can see on the chart there. And then we found SEC filings since the earnings date that indicate investors Rakuten Group out of Japan and then Fidelity sold over 10% of Lyft's outstanding shares since the third quarter. And so while they still have another 10% left, we think they may have continued selling, but this will ultimately result in a clearing event for the stock. And we think this is the main driver of the full round trip in the share price since the earnings print. You could go to the next slide. And so as Lyft has scaled the company's free cash flow, as Lyft has scaled the company's operating leverage profile over the last couple of years, the free cash flow has turned positive over the last 3 quarters, which you can see on the bottom chart here. And currently the sell side consensus estimates for the next 3 years are flat, which we think is too conservative given the company's growing the top line pretty robustly, and then with operating leverage. So that should continue to grow in our view. And so, and if you look at Uber on the top chart and how that compares on a relative basis, when Uber had the same 3/4 of free cash flow go positive, they started to implement a buyback and repurchase shares. And so we think there's a strong possibility Lyft does the same in the year ahead. You flip to the next slide. And so one major issue that's sort of been plague or a headwind to the share price and valuation over the last couple of years since the IPO is Lyft has had a pretty high share dilution from stock-based compensation. And so they had a June investor day last year where they started to address this. You can see there, they said they want to optimize shareholder returns. The stock-based comp has been between a 6 to 8% dilution annually. So that's new shares being issued to employees, and that's been a headwind, we think, to the share price. And a lot of zero interest rate era IPOs that we've looked at kind of have gone through the same issue. I've looked at a lot of fintech stocks that have done the same, and as the bottom line and free cash flow profile starts to turn positive, they're able to reverse the SBC dilution and implement a buyback or pay employees with more cash versus shares. And so Lyft is sort of at the same inflection point. You go to the next slide. And so we think there's, based on some app data and other alternative data sources we reviewed, we think Lyft has a great setup into the fourth quarter earnings sprint in I think 2 weeks. And so if you can see there, the daily active user count and year-over-year growth of Lyft, it was really strong in the fourth quarter, both on the driver side and the user app side. And this compares, it's much higher than Uber's year-over-year growth. And while Lyft mainly competes in the US versus Uber, we think that in the market's discounting the accelerating growth profile here. And then you can flip to the last slide. So a couple other noteworthy pieces of info on Lyft are it has high short interest, so around 12% of the outstanding shares are shorted currently. And so we think if the company reports another great print in the fourth quarter and this sort of forced selling dynamic with the private investors is in the rearview mirror, that could add some returns to the upside if there's a bit of a short squeeze there. Also, the company has been rumored several times to be a M&A target. And in the bank earnings calls this quarter, there's a lot of talk of the M&A pipeline. Morgan Stanley said it's their highest in 7 years. And so we think as the M&A activity starts to come back, this is a 10, 20, 30% chance that Lyft could potentially be acquired. So that would be a great outcome. And then the final thing I wanted to note is just in October, Lyft announced a partnership with DoorDash, and we reviewed those same daily active user metrics for DoorDash and also showed acceleration in the quarter. So we think that this partnership and dynamic will add a better competitive profile to Uber, which has Uber Eats. And so it's just a more comprehensive offering to Lyft's customers. So that about wraps it up.
Andrew, why do you think there's so much short interest? I'm just curious, high level about Lyft, did it get wrapped into the basket of the tech darlings of 2021, where it's just they all kind of imploded and it's all right, short Carvana, short DoorDash. It's just like the ARC sort of, trades, ETFs, and those sort of stocks that were in it. Was it just because it was part of that basket, or what?
Yeah, exactly. I think a lot of companies took advantage of the IPO market during that time frame, and I think a lot of them got a great valuation when they came out. And as I mentioned, we've seen this similar dynamic with some of those companies you mentioned, and also the fintechs like a Robinhood. And Affirm and Upstart, the fundamentals have really started to inflect. And while those companies are just getting to bottom line profitability, as you start to think about the forward estimates and valuation on forward numbers, they are, positive earnings companies now and generating free cash flow. And so as an investor, you can start to get paid in buybacks or dividends or accelerated growth, et cetera. So yeah, I think it's definitely lumped in that basket.
It's too bad Tyler's not. We'll have to send it to Tyler. He loves the beat down SPAC names, but it's pretty wild because when you pick apart all those tickers, a lot of the charts look the same, and then some of them are still really basing out like Lyft is, and then you had the Carvanas, the Lemonades, and some of these really take off last year. So we like it as a kind of back from the dead, forgotten trade, and Andrew's spent a lot of time around it, and it's also probably not getting the attention it deserves on the sell side, and these forced seller dynamic is pretty interesting. So it's shows there's more brains behind the Lecker operation than the shit talk that people get to hear here. And it's a cool part of our portfolio because we have this very macro driven approach, but then are able with Andrew's expertise backfill with single name high conviction plays that you can kind of think of as assets too, because that's something we can hold for a long time because we believe in the story and the growth, but then opportunistically tactically hedge against it, whether it's there's the ARC ETF, there's the IPO recently going to market ETF, Qs is obviously one. So it's fun to have good assets like this in the portfolio to kind of use and utilize.
Yeah, awesome, cool. Well, thanks for joining, Andrew. That was great. Yeah, nice to flex those. I used to try to attempt to be a value investor, so it's fun to flex those muscles again, even though this is a growth stock, but still
it's coming back. This year was the since 2000 the least amount last year, this least amount of single stocks that outperformed the index benchmarks. So it's something we're leaning into hard this year and investing in.
I like it.
Thanks,
cool.
Andrew.
Thanks for having me, guys.
Thanks.
Yeah.
Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee-free transactions. Whether it's gaming, AI, or next-gen dApps, Scale is here to power your future. Explore more at skale.space/ecosystem and follow them on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Okay, Quinn, what should we chat about? Fed meeting this week.
I think everybody wants to hear our opinions on AI because we're experts. So
I didn't know what General's Brown paradox was a week ago, but let me tell you about it.
AI, helicopter safety, aviation safety experts. What else do people want to hear about that we're newly? Yeah, it's good.
There's always a tariff thing. We can all find on that one. That's an easy one.
I think a good place is like the Fed. Obviously, big meeting was kind of went out without a hitch. What did you think?
Yeah, it was actually the most interesting thing for me. Well, there's two things. So obviously, like when we got the statement that came out, they changed some of the language around inflation, right? There's the tweak. And then pretty quickly afterwards, Powell came out and said, hey, they'll look into that as a signal. It's just like, we're just cleaning up language, as he says. So, even though the market sold off initially on that statement release where there's just basically saying like, it seemed as if they're saying we're more concerned about inflation than we were last meeting. Then he pretty quickly came out and reversed it. And, that's obviously just kind of shows just like how silly sometimes these Fed meeting things are, where we're just like hanging off every single word that these people say. It's pretty insane, but that was really interesting. And then also actually just the bond market reaction. So when we first got that statement out, we actually saw like the long bond yields surge pretty significantly, which, in my head, it's like, okay, if the Fed's coming out more hawkish than expected, makes sense to see the 2-year go higher, higher for longer type idea. But the fact that we saw the long bond go higher at the same time was quite interesting to me. But then we reversed it pretty quickly afterwards. So then we actually reversed on what I would feel like is a dovish press conference. If the market was actually concerned that the Fed was losing control of inflation, I feel like we would have seen the opposite. So I'm curious what you think on that.
Yeah, I mean, I was a huge fader of that like the market freaking out about that line, because I can't remember which meeting it was, but if you go back, it triggered this exact memory where he explained almost word for word in a previous, like maybe it was November or September, where he said, no, that's just a semantics change because we wanted to update and remove kind of the clutter. So that was kind of silly. And I probably think it was like slightly less dovish, less dovish, slightly more hawkish than what the market took it as. That doesn't mean it's bad for the market, because like I don't think it is anything he said is necessarily bad for risk or anything. But I do believe he kind of took March, quite fully off the table, and I think he balanced it, which I don't think is great necessarily. But if the market's fine, growth is coming back, like then he's not trying to send Bitcoin to 150 just for fun. So it makes sense. And I do think he balanced that, like taking March off the table, because there's two specific times where he kind of poo-pooed it, with reaffirming, no, we're restrictive. No, we still see cuts. We know we're going to get to 2. And the other slightly hawkish thing was like, 1, quantitative tightenings, probably maybe even now a H2 thing, hearing more, and strongly reaffirming the Fed's 2% target. So I don't know, it's kind of a nothing burger, and the market's like, still, there's nothing to deter the market from pricing out cuts. Like we saw this last year too, right? Remember in January, we started pricing out cuts, and that the market kept going up, and people were like, the doomers were having a fit. But
yeah, it's always so funny, like macro during these times where, I think it's the macro gets really sexy around beginning of cycles and end of cycles, where you can just like make this big call of an inflection point. It's like, just lever up in long bonds because the business cycle's over type ideas. But, for the most part, like, and this is what we've been talking about in the last few episodes, we're sort of just like, in this early to mid cycle vibe, and the macro's mostly fine. Like we got quite a bit of data, especially today. Like we got the core PCE print, and, if you annualize that, we're looking pretty good. We got some pretty heavy base effects coming for the first quarter of 2024 on CPI that will make the bar pretty low to surprise to the downside. So it's like that's mostly fine. We got the GDP print yesterday. Consumer was by far the strongest sector of GDP. Like I think it's 4.2%, which is just like unreal. Like the consumer is still spending like mad. We saw a downside surprise on it, but that was mostly because of like, if you could dig into it was like net exports. There was some inventory stuff, pretty idiosyncratic. But like when you look at the core of the American economy, which is the consumer, like things are fine. There's no big move or inflection point to try to predict here. There's no hero trade, I think.
Yeah, it is. It's a tough time to be really like, and we know if there's nothing to derail, like, I was bearish coming into the year. I captured 2 different times. I think I had like shorts on that I monetized. Like going into this week, I had those NASDAQ puts that with the vol event on DeepSeek just closed at the open, and because the market has been testing, hit going down, and it's just like, all right, well, if we're not going down, I guess the flows are going to come in, and the buybacks and big tech reported earnings, and it went around fine. There's not really that catalyst, and for me, I think I guess the other side of things in my mind, which I actually am I'm pretty constructive for the next few weeks. I think we had every FUD. We had an oil spike FUD. We had Trump tariff hysteria. We had AI, end of the world kind of hysteria, and the market, the indices couldn't go down. So, okay, I guess we got to test higher. I would say I'm like, I think, let's see, like I expect the next 1 or 2 inflation prints to be fine, but I think that there's more personally more inflation risk than growth risk, because like with 100 bips, people are maybe start to realize over the next couple of months, like in a fiscal dominant environment where they're spending 6+% deficits, 100 basis points of cuts, then you finally steepen the yield curve and make banks profitable again. All the bank lending, credit creation metrics are reinflecting higher, coinciding with manufacturing reinflecting higher. So I worry probably much less than the average macro person about the growth picture, and I kind of think that we will test higher in the first half of the year on yields, and that would probably implicate a higher dollar, and maybe there's some commodity upward pressure in that as well, although strong dollar kind of keeps a lid on it. But so that's kind of where I'm trying to be very optimistic, like constructive, and not get bearish to be bearish. So but
yeah, I feel like if I would I'd go a little bit further and say that there's a lot of pieces coming together that I feel like we could see Goldilocks come back, because I am very not worried about inflation personally. You look at oil, you look at gasoline, like that's on the floor, and I think it's going to either stay range bound or lower. I don't see many reasons for that to surge higher. We got the ECI, like the employment cost index print today. That was pretty, we're still seeing further basically like employment labor cost disinflation. And then you pair that with the JOLTS data that we have of job openings, like there's just no wage pressures at all. But at the same time, so we're seeing these factors where it's like, okay, they're the big driver. And then obviously the shelter thing, which we've talked about a few times recently, like that's going to further add to disinflation. So really your only big inflationary factor is the manufacturing sector and goods. So yeah, maybe you see a little bit there, but you compare that against all these other major factors, which are like much larger portions of CPI, like services is way bigger than goods. It feels like that's capped. So you have that going on, but then at the same time, like you just can't be bearish on the economy when you're getting a 4.2% consumer print, right? You can't be bearish on the economy when initial jobless claims are about to drop below 200,000. Like we're starting to revert, lower. Continuous claims are still flat; they haven't decreased yet, so there's still that. But you look at those more high frequency data prints, and it's like solid growth and not reasonable inflation. I think that's Goldilocks to me.
And we've seen it kind of across the world with ECB and Bank of Canada being giga dovish. Bank of Japan's probably not going to be in any hurry. If the end's at these levels, particularly, like it's fine. Like they're not going to be in a real big rush to hike. And yeah, it is kind of this Goldilocks. Like what I didn't appreciate, because I was in the cautious camp from late December, so probably earlier than most. I didn't appreciate how shook out positioning kind of got in the equity market and just broadly. And I think there was right reasons for that, but it was, people really pulled back gross, and the market tends to do this, like shake both sides of the tree, and it's in crypto, run all the stops and then do it. So wouldn't surprise me at all if like people are complacently like cautious bearish and the market rips higher up to new highs in stocks, and then sees from there, because we still don't know when the Fed will cut. But yeah, the economy is like, it's tough to, until we really, like, the budget stuff is the next big thing, in my opinion. Like what actually happens, does Doge actually bring that down? And otherwise I do think there's another real rate kind of scare or pump in a sense if they don't fix the deficits.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at skale.space/ecosystem. And follow their journey on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. I mean, the whole thing is like, it's basically around where do you think we're at neutral or not? And this is like, even the Fed themselves are, all over the place on this. So it's okay if we are too, right? But like, their whole thing and most people's thing is like, you just got to feel it in the market. And I think, when you look at the feel of the market and how things are moving and how the, economic data prints are coming, it feels like we're around neutral. I don't know if I'd say we're restrictive. If you're Goolsby and you're coming out here, he was in a speech this morning and he's like, oh, we're so restrictive. Like, let's fucking cut another.
This guy must be like 3x levered long Bitcoin at all times. He's
100%. That guy's fucking long duration to the gills or something. I don't know.
It's hilarious, dude. I mean, yeah, like you said, it's hard. It's really hard to try and predict a huge inflation scare in the next 6 months with no shock of any kind. Like we're in this range bound and the Fed thinks they're restrictive. So if we just stay here, you got to imagine they're good for another cut or two. And I think that's what gold's move to new highs this week really was we're in this. Was Powell going to follow up with repeated December? He walked it back quite a bit. And I'd say like maybe this is a good transition to some of the stuff going on the Trump side is, I think Bessent, one, we know Bessent's an absolute beast. I have a huge man crush. We got to like how, what's his name calls Yellen bad girl Yellen. We got to start the bad boy Bessent nickname, but
big man Bessent.
Yeah. And, we're seeing in Trump's demeanor and we're seeing in his policy statements is Colombia, right? That stuff kind of got walked back. The Mexico, Canada talk big. And then Bessent's probably behind the scenes saying, all right, well, Trump, Donald, you can come out with this, but then you're going to see the S&P down 5, or do you want the S&P new highs and offer this? Oh, we're not going to tariff oil. We're cognizant of inflation and like these, behind the scenes, there's real markets people running this operation. And I don't think necessarily like eventually gravity to some extent, you can't fight gravity for forever, but it's clear to me that there's a very outsized focus on outcomes within the market context that they're adhering to. And so, Biden, that's not something the previous administration was doing and slashing regulations. So it does seem like this animal spirits could continue.
Yeah, I totally agree. I think even if you just compare, like this is something I tweeted out the other day, but if you just compared Trump's, in the last administration in 2018 or whatever, when he was fighting Powell, he's like, Powell, you need to cut rates. You need to cut them right now.
Yeah.
He's doing the opposite this time. He's actually focusing on the fundamentals. That is, there's obviously like some smarter folks than last time where it's like, okay, instead of just trying to force Fed funds down, if we just drill, baby, drill, get headline down, get energy prices down, Powell's going to love that. He can cut like that. That makes his job way easier. That makes everybody's job easier. So you can see like, he wasn't just like, obviously he thinks Powell should have cut this week, but he's more focused on, okay, well, they messed up on inflation, which, you could argue they did, but they're focusing on tools that are actually a lot more effective for handling inflation. Lowering oil prices is 100 times more effective than trying to just smash Fed funds higher and then just hoping that trickles into the economy, right? So there's obviously, you can see it. There's a difference in approach here, and it's, again, good, I think.
I mean, if you just take a step back, I agree with you. We had our LP update call yesterday, and I said the number one most bullish catalyst from a macro perspective I can paint this year is if the energy policy can deliver progress. How quickly can that happen? Because if you get oil under 70 consistently no inflation, the Fed's going to cut into that hard. there's not going to be, and then I think taking a step back, right? Like, think about from his election day in November to inauguration day, which was the peak in tariff hysteria. That's like, it was guaranteed tariffs, maybe 50%, maybe only 10, maybe only 20, and now, like, I guess we'll see, he said Feb 1, I think. So maybe next week, knock on wood, we're saying this and all hell breaks loose. But it's just so clear from previous, his last 4 years, like his handling of it. And if there was a poly market for what tariffs would be come 2 weeks into his administration, you probably could have sold that contract for like 80% or something really high. And so, yeah, it's clearly, it seems like a more sound strategy, which
there's a lot of people going into that first hour saying, you need to take Trump seriously this time on the tariffs. He's going to do it day one, but yeah, so far it's tracking just like last time, and it's more a tactic because it's a powerful one. Like, yeah, I'm up here in Canada, and tomorrow I'll know if like we get 25% tariffs or not, and like our best. Like, I don't know, for some reason our side of the politicians over here are thinking that we can fight this battle, which is ridiculous. I was at a conference last week and I was listening to Dave Rosenberg was there, and he's speaking, and he's like, well, look, like if the US does tariffs on Canada, that's a negative 2% hit to GDP. If Canada retaliates to the US, it's a 0.2%. Yeah. That's the difference. That's the difference between a economic depression and a mild annoyance. Like, that's just, if that's the maximum we can go to, that's like losing game theory right away. So I don't know what's going to happen. But
when's Trudeau out?
Like March. So he prorogued government, which is like you can kind of suspend government, which is kind of wild. And so right now they're going through the motions to nominate a new leader for the party that he's in. So kind of like a Biden-Kamala switch is going on in Canada right now. And then once that occurs, then the election is going to start in March or so. So not only do we just have like all this going on with the tariffs, but we have like a lame duck prime minister right now too.
Sounds lovely. For once, the spotlight is off the U.S. in terms of the clown show.
Yeah, exactly. I'm curious your thoughts on just the sector rotations. So that feels like it's been a big thing this week. We had the DeepSeek thing that triggered a big sell-off in tech, big rotations into value. But we've seen a rebound. Qs are already above where it was pre-sell-off. So I'm curious how you're thinking about different market factors and just these rotations here.
Yeah, on Monday when I in the morning when I was seeing the market, and it was really mainly like the Asia session and Europe sessions that the deepest cuts were made. I was kind of like, oh wow, like AI can proliferate more, cheaply across regular businesses. Like, that's generally a good thing, but it was very obviously negative as a scare for the leaders of the market. So for me, like, it was such a, there was huge dispersion that day. It was such a narrow pointed kind of event as to what it affected. And I think, to me, it doesn't probably change a whole lot in terms of like demand for this stuff. I think it was just simply a positioning thing. It just showed people were levered to the gills in one, concentrated in one theme. I mean, you had like the power utility energy companies down 25%. And, what portion of their business is AI related? Like, negligible. And it just shows how much fast money and kind of hot air was puffed into this theme. And retail too, right? We saw, the more speculative AI, parts of the market getting clobbered, and now they're kind of all clawing back. And so I think I think that's the other thing people need to remember is the index level valuations are extremely elevated, but that's partly caused by, high 30s Mag 7 PEs combined with like mid to low teens S&P 493 PEs. So there's a lot of room, and particularly, right, it's expected. And if you just look at his last term, Trump was very bullish for value, small cap, cyclicals, Main Street. He was still fine for Wall Street and other stocks, but the relative performance was skewed. So to everything that's been lagging now. So there's a lot of, I would say, tailwinds for that. I don't know if that trade like takes off instantly now, like small caps over NASDAQ. Given I kind of think that the dollar and yields probably rise again sometime in the first half, maybe we retest that again. And it's not until we get definitive Fed cuts that small caps and the cyclicals really bolster their outperformance. But yeah, I think like when you start actually diving beneath just what the NASDAQ is doing on a daily basis, a lot of stocks look pretty fine. And I think the single asset opportunity set is pretty interesting and something we're spending more time with. So I think you just continue to see this rotation because it's like, well, I can't sleep at night pumping like huge allocations into the SPY at 25 forward PE, but there's a lot of opportunities out there in other sectors that I can get comfortable owning at better margins of safety.
Yeah, I'm a pretty big fan of like the moving towards the equal weight ETF of S&P because like Russell 2000 has some issues. Like those are some pretty deadbeat shitty companies. But then you don't want to own SPY or Qs either because those are market cap weighted. But the equal weighted S&P, I think that's an interesting one to me.
Yeah, because if for me having a higher long bond yield bias means for the shitcos that finance have poor access to financing, that's not great. And I would say, well, a steeper yield curve is probably all else equal worse, barring a recession for the large cap. So I agree with you. It's like those, maybe it's a equal weight RSP or it's like a value index or something that is still kind of skewed towards quality, but yeah, that's where Russell suffers is it's low quality.
Yeah, exactly. Man, it's okay. So just circling back to what we were talking about before, just as we were talking here, we got some new headlines from Trump on the tariff thing. So now the Mexico-Canada tariffs are looking at March 1st, not February 1st. So we're seeing them move back a month again. So, like getting back to what we've been talking about, how it's the dangling. The dangling is going to continue. So I don't know. It feels to me like there's some negotiations and yeah, it's just, if this trend continues, like the dollar and yields are overvalued, or at least the dollar is overvalued in that regard.
Yeah, I think actually that's a good point to bring up is at some point this year, if the economy stays strong and inflects even higher, which it kind of looks like it might with some of this, we're getting a manufacturing and credit growth rebound that we haven't seen in multiple years. So those are usually important things. Plus you're going to hope, what Andrew mentioned too, everybody's talking about capital markets activity. I talked to all my banker friends and they're like getting crushed because everybody wants to go public for once or M&A activity. Those are liquidity events, really usually healthy for the economy and markets in general. So you could see a reinflection in growth. Would kind of also make sense given how everyone's number one worry going into the year was a growth scare, kind of how the market's going to stop out both sides first. And you could really see where if that happens and the dollar weakens, just more structurally, where yields actually can rise while the dollar weakens, right? Where growth and the cost of capital, higher growth expectations globally pushes yields up. China and Japan are buying less treasuries, deficits still exist, but the dollar's weakening, which that to me is would then eventually be a concern, not right away, but that would potentially put a floor on commodities with a weaker dollar. And that's when you could see inflation restart. But dude, Besant, like this guy, I mean, I haven't lived through many treasury secretaries or administration changes, but I'm trying to go back where like, imagine me and you are sitting here having like, just spelling out our high level, strong conviction views. And then we go in the administration. He's not changing that. Like how often do you get this like successful hedge fund manager who's done interviews and podcasts like Druck has for, 3-4 years. And his views on the dollar, yields, energy policy, all this stuff from when he was investing. And he's going to apply that, like that meeting with Japan that's coming up in February as well. Like everybody knows, kind of got to get the dollar down. The yen's kind of got to strengthen. Japan's got to find a way to keep hiking rates. Like this guy's brilliant. Again, it's not something you can rest your laurels on and say, well, just because Besant's a G, like, S&P to 7, but
well, it's going to be an interesting, it's going to be an interesting experiment to see like how much of this whole game is like, is it Yellen just on her personal opinion that, she wants to, weight bills and pump the stock market? Or is it like, we kind of feel like we have to do this, like there's this whole game of like, is the game set already and the players are just playing the game? Like it's inevitable that we have to weight bills over coupons because there's just such a huge debt problem and there's not as many marginal bars on the long end. So like in February we're going to get the first QRA with Bessent as chair, and that's going to be really interesting to see. Like he's been a huge critic of that approach of weighting bills like Yellen has been doing. So it's going to be where the rubber meets the road. It's like, okay, well now you're in the risk chair, right? And you're making those decisions. Like, do you decide to weight coupons more and risk a major sell-off in the bond market? Like that's not going to do good things to the risk, right? So it's going to be very interesting to see, does he stick to his guns in that regard?
Mm-hmm. Yeah, man, that's almost maybe the most important thing I would say, because next week I kind of expect data to be fine on the labor market. Like it's hard to see why things would weaken dramatically or be a gangbusters print. So to me, that's a really important one. If you're him, again, like sometimes like on the macro stuff, especially when people start to get doomy, and myself, I can get bearish with the best of them. You have this tendency to want to think like you're just more negatively tilted. And the fact of the matter is like, no policymaker wants a market decline on their name. They want to inherently do the right thing. I would say there's times where they definitely does not seem like that, where they do more manipulative, not right things. But in Bessent's case, he's like, okay, he's served up on a platter, a nightmare of a problem where Yellen was absolutely, like it hadn't been done in a long, long time. It's an emerging market central bank thing. And so how do you approach it? Well, to make it calm for the market, you probably have to phase it in over a year or whatever it is, many quarters. And so, him and Moran have spoken so openly and honestly about that. That's what I think this is so interesting, is like, if I'm them, I'm probably just coming out and saying in those minutes from the QRA, look, this is the problem we were handed. We're going to do right by the government, the people, the taxpayers, and we have to fix the problem that Yellen and Biden gave us. But we're going to do it in a way that's not going to we're not going to fix it overnight and like crank the long end bond yields to 5.5 and ease it in over time. So, and then hopefully they get, 2, 3 Fed cuts, in a sustainable steepening of the yield curve. The Fed liquidity helps bolster, things in the economy and the markets, and, the long end yields more sustainably rise, not anything vicious. So that's what I'm looking for in kind of my base case. I don't know. Yeah. Like it's hard to see him coming out and saying like, we're just going to keep that policy, right? Like that'd be kind of, yeah.
I think that's the most reasonable outcome. I've also seen some insane like conspiracies where people think that like, oh, Bessent and Trump, they want a market crash because that's going to create a bid for long bonds. And the sooner they do it, the more they can blame it on the Biden admin, because it's like, oh, it's February, right? Like look at what we took over. And that obviously creates a pretty significant marginal buyer of long bonds. But I don't know, it feels a bit much. Like there's like a Arthur Hayes always makes these big essays, and I still read them for some reason. But one of them, he mentioned, he's like, "Oh, what if Bessent, plays hardball with the TGA drawdown on the debt ceiling thing?" And I'm like, I don't think Bessent's first move is going to be to play chicken with a debt default. That seems kind of insane to me.
Yeah, remember that Treasury secretary that came in and he just said like threw his middle finger up to everybody. It's like.
Saw the first, U.S. debt auction default. Like that just seems insane to me. So I don't know. I feel like
I think he's thinking what he used to do at BitMEX when he would when the exchange would run everybody's stops. But we're dealing with a little different situation.
Yeah. No, I think your approach is the most reasonable. Like he's not going to just play the same status quo of Yellen. He can't. But he's going to, they're going to try to guide it the same way they're dragging out the guidance of tariffs, right? Small iterative increases. I think it'll be the same thing for that.
Can I just, and I got to just talk about it, but we're going to be coming up on a year when I made that Trump unification thing. And the amount of, and people, listeners of this show know where I sit from what is right policy and then also my leanings politically. But the amount of people, now everybody I speak to is more gung-ho about Trump and the administration than I am. And it's like kind of funny because I'm like, yeah, like I'm trying to be very balanced, and everybody I talk to is like, I can't believe how much they're doing. I can't believe how they're going about handling these things. I can't, and I'm just like, and it's just an interesting, just perception and switch really. I mean, yeah, like it's hard to argue with it because with all the problems handed on the RRP being to zero, the Bills thing being a nightmare, stock markets pumped to all-time high record valuations. It's a uphill battle. Let's say there's a tight loop to thread in terms of making this year go well. But I mean, there's the people in place, and if they're able to get energy down, allows the Fed to cut, issue more duration, curve steepens, Main Street's fine. They do some cutting of aimless government spending that brings budget and total debt issuance down. Like, there's a world where we have another 15% year in the S&P. Like, I don't know what's going to happen. It's probably not my base case because there's just that's a really, really, really Goldilocks outcome that, just history says it's not always that smooth, but it's not impossible. And you can't just get bearish to get bearish.
Yeah, exactly. I do see a larger path towards that Goldilocks outcome than probably earlier before, especially seeing that it's becoming a much more measured approach on tariffs. Like, I just looked and, the dollar Dixie is falling, down 30 basis points right now. So, there's a lot of concern baked in, and any marginal reasonableness is going to lead to further, improvement, I think, in this macro dynamic. So yeah, it obviously it's going to be a headline heavy world.
Yeah. The moves are actually kind of big. I mean, oil's down 0.5%.
Yeah.
I mean,
so I mean, you just look at everything we priced in the last month and a bit, and, like, maybe we can finish up this talk with how that affects crypto, because the Bitcoin situation in crypto is an interesting one to me, because it feels like that's one where the macro backdrop of, like, correlations to global liquidity, whatever you want to call it, Q's correlation or whatever, that to me is pretty good. But there's like this marginal, layer on top of idiosyncratic positive headline expectations around things like strategic Bitcoin reserves, et cetera. That's kept it marginally higher. We've seen a huge capitulation in alts, but Bitcoin's remained solid. So I'm a bit more, neutral on that one, because I'm just not sure about how the expectations of these headlines coming in. Obviously, we've seen a major pullback in that. Like, we had the executive order came in that was about, like, a strategic stockpile, not a reserve. So maybe that idiosyncratic expectations around headline has already been pulled out of the market, and now we're good. But it feels like we have to resolve that before we can get the big, break higher. What do you think?
Similar kind of take. I was just generally pretty cautious. Like, coming into the year, everybody was on one side of the boat. The optimism and was so high. The Trump inauguration was like, at some point there, setting up to be a glorious kind of, news failure, sell the news type of thing. And it never really materialized. So that's interesting. And you have to write that down on your notepad as a win for, the bull case, like, in the same way that stocks kept testing lower and lower, and getting bid back up. Bitcoin's been the same. And so we're just kind of digesting, is how I see it. We're digesting through some of that just very, very ambitious positioning, and everybody being long, and your family members being long. And so, but again, rates falling, dollar falling, oil falling, tariffs pushed out, growth being fine, earnings being fine. It's like, again, the path of least resistance might just be more upside until something derails. And I actually, again, I was saying I was kind of more cautious for big parts of the month. Caught a bunch of some of the, like, kind of moves up, and then de-risked when we got to the top of the range. And I feel like there's a higher probability now that we do kind of push higher. It seems like sellers are exhausting a little bit. Saylor's still doing his thing, and it's a good narrative. Like, all the states, the reserves.
The big concern for me was, and I think we talked about this, like, before the inauguration, was like, what happens when you don't get the Bitcoin reserve, which we all thought was unlikely, and you just get the stockpile, which is just a fancy way of saying, well, we have already, we're going to keep. And that's looking like it's going to be the case. And I think the market's got to about the point of digesting that now. It's come in the form of all just getting absolutely destroyed and BTC ranging. But it does feel like that we're nearing the end of that. So maybe that's, to our point, like, that's where you can get this next leg now.
And one of the things, like, you don't base big time decisions on seasonality or sentiment in and of themselves, because these things they're flimsy. They're not hard data. But going into the year, both of those things, I would say were like, well, the sentiment was like extremely stretched, and the seasonality in January is like whatever. But now you kind of had all that exuberance rinse out in a pretty big way. Like you're not seeing anybody calling for the imminent alt season anymore on Twitter after all these alts got like minus 30 carried out, while Bitcoin is literally bumping up against all-time highs.
And AI coins got taken out of minus 80%.
Yeah. Like, so in a way, those are other data points you need to be, again, putting down in the bull case, which is all this froth just got cleaned out. And, it's definitely not a 2022, 2023 completely clean out, but it's a near-term reset that allows for sentiment and positioning to kind of push back into the long side. And even you look at futures open interest and funding and other things, again, it's not the cleanest in the world, but it's pretty clean relative to the last few weeks and months. And you still, I would say, have a lot of those tailwinds. I mean, the ETFs, we're now getting ETFs for every coin. The exchanges are listing. I think countries and sovereigns are probably big dip buyers, states. Yeah, it's this new maybe regime for Bitcoin, and everything else you need a very specific catalyst. Like the dispersion is going to continue.
Yeah, and to that point, the last thing I'll say before we wrap here is just on the sentiment thing. Like it's not actionable, and it's heavily like filtered by hindsight bias, where the one thing that marked the top people anchor on. So it's like, okay, we got the Michael Saylor Forbes magazine cover this week, and like, oh my god, that's a top sell everything. Yeah, just those things are not actionable. They're fun to tweet about. I love to shit post about that stuff, but like it's not actionable because it's all filtered by hindsight heuristics. Like you just focus on the one thing. Like last cycle it was Coinbase being the top app, so now everybody's focused on that. So yeah, you got to have a better plan than just sentiment, because that'll just throw you around everywhere.
I would say like these last couple of days too, where Bitcoin's kind of just treading water. It's like in the old markets structure without the ETFs and the higher degree of like macro intertwinedness and correlations, you'd probably see like higher volatility, more fake outs to the downside or fake outs to the upside. And it's like, that's the other thing that it's becoming increasingly, intertwined with this system of flows and passive. And you're just not, I think it's driving people nuts who are used to the old market structure and just patience. Like the market wants you to action. And sometimes the best thing is no action. And it's January. Like we got 12 months, 11 months now to make our bread for the year. Like you don't have to swing at every single pitch and have an opinion on every single thing. And sometimes you get them wrong, but like just be patient. We have 11 months left.
Yeah. I think last cycle you would have seen one of those major BARTs down to 75K or whatever, but this time it's just like 89K flush and then back to range. And then the range is the capitulation. And it's it's very interesting.
Yeah, I like just think about how many people are underexposed to even gold relative to the moves gold's making, and underexposed to probably Bitcoin. Like I'm becoming increasingly very, very, very selective with when I touch non-Bitcoin crypto assets now, because you have a way worse margin of safety, and I kind of look at things like that. And the miners actually this week were really provided some nice entries as people got spooked on all that stuff. And then you see like SoftBank's announcement and other, Microsoft reaffirming their CapEx budgets, Meta. So there's opportunities, I think, out there, and it's very traders like market, like a lot of ranges probably, and a lot of assets, not just Bitcoin, but probably stocks. It's probably going to be rare to get ranging environments, and it's going to just make everyone pull their hair out if you're thinking for these, like everyone's so conditioned to like the 2021, and 2022 was straight momentum down. 2023 was pretty up for like, it's just like, those are abnormalities, not the norms,
Yeah, totally agreed. All right, well, I guess we'll leave it there. Hopefully Tyler will get his shit in order and will join us next week again. But we miss you, Tyler.
We're implementing to the listeners a fine system. So he's going to start punishments, and then we got to give him some shit for that. But yeah, hopefully we'll see him in New York too for DAS. Got to pump that.
Yeah, exactly.
How are numbers looking?
Yeah. Numbers are looking really good. Yeah, we're basically sold out on sponsorships. There's some tickets left, but yeah, it's crazy to see the difference in just the appetite for US conferences ever since the election. So yeah,
True.
this one's going to be nuts. We've been hanging our hat on the US thing for conferences while everybody went to Asia, and now it's going to pay off. So yeah, thanks for the reminder to shield DAS, but it's going to be a banger. Quinn will be there. I'll be there. There's going to be a lot going on. Get your tickets.
Pumped, man. Right in the heart of New York, all the action. Like the names, the crypto, the macro, it's going to all be there. And it's just such a great week to meet people and network, investors, other smart folks. Yeah, you guys do a good job with those.
Yeah. Going to be fun. All right. Have a good weekend, everybody.
You too. See you guys.